We're going to talk about on the fixed income side. Now, fixed income is anything that's not a stock. You think about bonds and cash, that's fixed income. We've worked on a new model to try to generate some extra income in that area, so we'll be talking about that. And also, I'm going to start off by taking a look at what we've done with the research that we put together the last 5 years. So it's 5 years ago that I got very disenchanted with most of the research that I was buying. So I would go buy a research report out, and build a model for our clients, and it just didn't work well. And got real frustrated, and found the young guy down in California, Alex Barnell, that said he could help me with some research and analysis. And sure enough, one of the first things we had him do was test what we're doing, what's going on with the research. And we found that much of the research we were paying money for just wasn't right. So if I paid research for this item right here, and it tells me blue, but it's really red, I'm at a great big disadvantage. So I decided 5 years ago, I'm going to do my own research. So I've got Alex, I've got Parallax, I've got Bergstrom here, all helping get our intellectual capital where we want to be. So the strategy we came out with, the first was a value strategy. Now, what is value? Well, go to the store and buy a loaf of bread. If you go to buy bread today, and then say 2 for 1, well, that's a value, isn't it? If you go buy gasoline this afternoon, it's 20% off, that's a value. And with stocks, it amounts to you buy a stock that's worth this much, but it's selling for less than that, so we can buy a value stock. And that was our persistent value strategy. Well, we rolled it out 3 years ago with the understanding, as we told you, it's going to take 3 to 5 years before it's actually matures enough to see how well we're doing with it. So I'm going to take a look at this, and you can see that this year it's made 12.48% for the year, and the market's made 11.38%. So that's a little better than the market, but that's over a quarter. A quarter is too short a time to be able to tell much of anything. That's why when you look at your statements on a daily basis, you see a bad number or not a good number, you really can't afford to wait too much with that. It takes some time for these things to grow, see really where it's going to take you to. So now let's look at it from inception, a 3-year period. And over a 3-year period, we average on our stocks 13.3%. And the market average 9.7. So 37% more than 9.7 is what? 13.3. So in a 3-year period of time, we generated 37% more than the market did. That's enough time to be able to really give enough time to be mature, 3 to 5 years, where to go with that. That's a value strategy though. So with value, there's other strategy is growth. So growth maybe is a momentum type thing. You look at a stock that's moving up precipitously fast, that's a growth stock, right? Earnings may or may not be as important, but it's a different type of stock. And it also, they work differently. So there can be periods of time where growth stocks are real popular, doing real well, and value is not. And there can be a time when value is doing really poorly, and growth is doing really well. So what do you do if that's the case? You diversify, you do some of both, right? And so we started out, I guess, about a year ago doing research on a growth strategy. And Alex did a really good job with that, got it in place, and it's done real well for us since the first of the year. As a matter of fact, it's done 22.9% this quarter versus the market. That's a huge difference, right? So one thing we're going to do is come into your quarterly meetings, you're going to hear me suggest, let's allocate of your stock you have invested, I'd like to allocate 1/4 of it to growth stock. And we may eventually go to half of it to growth stock. Because what we're trying to do with your portfolio is to find a way to make more money short of investing more heavily in stock. So if you have a balanced portfolio, maybe 60-40, right? Traditionally, the only way to make more money is to get a portfolio that now is maybe 75-25. That's a riskier proposition. So we feel like if we can get a portfolio that is diversified with some growth and value, we can get a greater return without having to go up in our allocation methods we go there. So I want to give you a quick update on that. And I want Alex to take a look at really market as the things we're looking at, because what we in my office look for are the things the way you will benefit. The way you will benefit is with a recession. Now, how can that be? How can you benefit by a recession? Well, you can't benefit with the way most people invest money with a recession. Because the recession goes down 40% and you go down 40%, now you have to have about an 80% return to get back to even, right? But what if you had your portfolio is at $1 million, it goes down to 900,000, we get out of the market, and then when it takes that real fast run up, we catch most of the run up. That's how we get a bigger compound return. Alex and I were talking just last night, we haven't had a recession since 2008. So we're kind of due in right now, and I want to put in context what that means. Recessions, bull runs, bear markets, inverted yield curves, all those terminology you hear, it's all part of the game. Yeah, I played football and ran track. If you looked at the end of the score of a team at the end of the first quarter and said, well, this team's ahead by 2 touchdowns, who's going to win the game? Do you know enough to where you'll bet everything you have on that? No, you won't. Because you know it takes 4 quarters to get through the game. So I want you to actually take a few minutes to kind of share that and then introduce with Dave the bond strategy we have.
Yeah, so topic today is fixed income. We wanted to kind of bring back the things that we teach in these seminars to a little bit more elementary level, just to make sure everybody's on the same page, but also to refresh a lot of things that are good things to know. Just to recap this quarter, we were looking at the data as one of the worst fourth quarters in history last quarter. It definitely did not feel pretty good. But the data we were looking at, the economic data, was just incredibly strong. Meaning, statistically, we were both thinking that we could see a very, very sharp correction to the upside, and we could see a very good next couple months. We actually had even better than that. We had one of the best 67-day returns in the history of the stock market. Essentially, or basically this is the last 10 years, but we've just gone up straight up from the December 4th Christmas low. And so you'll see right now a lot of your portfolios will have a little bit more cash than usual, and that's essentially because of this. We know that we've gone a little bit too far too fast, and it's just prudent to kind of lock in a little bit of gain here while the data catches up. Another thing that happened was the VIX, the volatility, had the biggest quarterly drop in history. So we're just getting a lot of rebound right now, and a lot of it is from that good data that we saw back in December. Now the data's changed a bit, and we're going to go over that in the next couple slides, but you've probably all heard of this sell in May, go away phenomenon. Typically the stock market sees the biggest gains in the first part of the year. That's what this shows, the last 20 and 10 years historically. Summer is the summer doldrums. You usually kind of get an eventless summer, and then typically the fourth quarter is when you get most of the gains. So we're kind of being cautious right now because of a lot of these particulars, and we'll also show some economic data that supports this. So what me and Dave do is we look at different behaviors in the market. This is actually interesting. We said, okay, let's go back and look at the last times in a quarterly period where the market was up over 20%. We're up by 22% right now. What happens in the next 6 and 9 months? Well, typically that's a good sign. There's only been 2 times in the history when we've found this where the market's gone down in the next 6 and 9 months. Typically you go up another 6 to 12% in the next year. So that's kind of a good sign for us going forward, but it's also important to understand that these things really aren't predictive. They're just kind of looking at past behaviors. What I talked about a lot in the New Year's Speakers Bureau is the data we're looking at really shows that Europe is kind of imploding right now. So Germany's factory orders and a lot of the Eurozone is getting really weak, and this is actually showing up in the United States data. This is saying that companies that have over 50% of their sales overseas are seeing the biggest drops in profit and earnings. So this is kind of a risk that we see. Companies that have more of their sales and growth in the United States is the blue. Those have been staying much stronger, and so it's important to watch these things because that could be the potential catalyst for a recession, and we're watching that very closely. The thing that's happening in the United States is, we actually had pretty flat earnings last summer, and then we had this big drop, and then we actually had a very, very strong rebound. The problem is the earnings expectations, which is this blue line, the consensus line, it hasn't really started going up yet. So it's really a cause for pause, because if you don't have the fundamentals of the market supporting the price movement, this is where you can actually get some really adverse moves. So this is something that, again, is kind of giving us a yellow flag. And the thing that's really more concerning is a lot of the smaller companies in the Russell 2000 index, their net debt that they owe on bonds is growing really rapidly, but their earnings isn't growing at all. It's kind of flatlined. So this can't really go on forever. This is something that could be really, really risky. And even though we don't really own any small cap stocks, this is something that we're seeing as a very, very big potential risk. And we're trying to avoid any of the risks in this area as much as possible. I'm just going to flip through some of these. So quarter to date, you got technology, industrials, and consumer discretionary, all very cyclical sectors, up the most. So that's usually kind of a good sign. The one really very strange thing that's happening is healthcare had its first down quarter in a very long time. And, basically it's because some of the left-wing Democrat candidates are coming out for universal Medicare, and it's causing a lot of the drug companies to get extremely cheap. We've had some positions in this sector that we got stopped out of, pretty good. We didn't lose money on most of them, and they've gone down much more after that. What's really interesting, though, is for our value strategy, a lot of these companies they're never been cheaper. They're Bristol Myers Squibb, for example, a massive pharmaceutical company, has never been this cheap to buy in the history of the stock. And there's a few other companies like that. Even Johnson & Johnson is showing up on our buy list. These are going to be tremendous opportunities for us going forward once all this political risk kind of gets figured out, because these companies are very, very well run, high profit companies. So there's a clear opportunity here for us to profit once we can kind of see the stabilization. What we're going to talk about today in our focus is fixed income, and one of the things that's happening in the fixed income markets is the yield curve inverted. And I'll explain this in future slides, but the bottom line is when this happened the last 5 out of 6 times, it signaled a recession to happen, I think 6 to 12 months in advance. So it's not an imminent signal, but it's got a pretty good track record. It's only happened 5 times, so it's not a pure statistic, but it's something that is, again, a cause to be a warning sign for us that we are definitely in the late part of the economic cycle. And so we're watching these very, very closely. So what happens? How long until a recession from an inversion? These are every time we've had an inversion, the date. And you can see it's basically about a year. So it happens much earlier than the recession happens. Gives a good heads up. The other thing is, what does the stock market do in the meantime? Well, typically it actually, on average, goes up double digits and about 20%. So this is basically gains that we don't want to miss out on. Even though we know that the warning sign is about a year off, we want to try to get as much of this as we can get. And that's kind of what's been happening the last few months. Certain sectors obviously do better than others. I'm going to kind of flip through some of these. And so one of the things that we do is we're watching these signals, these economic leading indicators, but I also know a lot of people in the industry, and so just curiously, I kind of asked a lot of them to send me some of their reports, and so we can kind of double check what we're looking at and make sure that we're not too off track. This is from Credit Suisse, and they have a similar model. This is showing the probability of a recession in the next 12 months, and theirs has shot up quite drastically. This is Charles Schwab's model. Again, it's one of those where if it goes down below this line, this is from their blurb about it. It says, it's never crossed 99 and not seen a recession. So they could have said that differently, but basically 99 is right here. It's at 101. So the Charles Schwab is sending this to all their financial advisors to be, aware of this. This is another company that does a recession model. This is Bank of America Merrill Lynch. They said right here that our indicator has fallen into recession territory only 2 times other than this cycle without an official recession was 11 and 14. So the Bank of America is a huge asset manager, and they're warning their investment managers. Ned Davis also has a 90% chance of a recession in the next 12 months. This is Morgan Stanley's model. So all these players are basically confirming the same thing. And I think that feels good that we're at least on the right track. If there was like a mixture of these big companies saying half are, bullish or bearish, we'd be a little bit confused. But at least, these guys are very highly paid and very similar. This is also trading, world trade. So we're definitely slowing down. Now, we're actually kind of excited for this is because the strategies that we use have features that are going to enable us to gain in very large amounts during these times. And it's not going to be by picking the best stock. It's going to be by basically getting out of harm's way when things start to get bad. This is retail sales. You can see that when this goes down to 0, it's the shaded regions have been recessions. You can see they don't last very long. They're about a year long. But we want to be able to get out of the way before this thing happens in advance. So I want to tell you guys that because, we're seeing these things change and the data changes, and we want to make sure to communicate that now because as it gets closer and closer, just be aware that will be some larger changes in the portfolios as we get the signal to kind of get in this safety mode. We still think we have plenty of upside to get in the next year, like earnings are pretty good, but at the same token, we want to just be aware of what's going to happen. So the next part of this is sort of the educational portion. It's about bonds. We talk so much about stock market, which is kind of the 60% of your portfolio. Today we want to talk about this other portion that is meant for income and stabilization. So the basics of bonds are as such. Typically a bond is issued at $1,000 face value. Sometimes it could be units of that. And they usually have some type of interest rate that they're going to pay. Right now, interest rates are so low, it kind of is tricky to understand unless you make it really simple. But if I gave Dave a $100 bill and I said, okay, give me the same interest rate as the Treasury, I would wait 10 years and he would give me back $100 and also $2 more. That doesn't seem like a very good deal, right? I mean, inflation over that period of time. It's the safest thing in the market, but it causes distortions because now I don't think that's a very good deal. I'm going to take my money and try to go find a better investment, a better return for my money. So the other thing that happens with bonds is they have maturity. So they come in, 1, 3, 5, 7, 10, 20, and even 50-year bonds now. And so that's basically the duration. When a bond is said to be trading at a discount, it means that the $1,000 bond we had is now on the market, currently trading on the market for only, say, $9.80. And so usually something's going on with that bond. Someone's either trying to liquidate it or the credit's not good. The flip side, if a bond is trading at a premium, say it's a $1,000 bond's trading at $1,020, that just might be a really strong company or there's certain tax advantages to this bond. But again, the price of a bond can be above or below the par value. The interest rate is called the yield. This is essentially how much you're going to receive on an annual basis. So if you ever see something on a report or on your statement on what the yield is, it's essentially how much interest you're going to receive over that time. Again, if something is trading at a discount, it's typically got a higher interest and the vice versa. That's really kind of the trickiest thing that is hard to grasp when you first learn about bonds. When the price of a bond falls, the yield or the interest rate rises. And the opposite, if the price of the bond rises, the interest rate or the yield falls on the bond. And so this is a relationship that can never change. It's always going to be, linked. And so the one thing that does happen is the longer that the bond is, so if it's a 6-year bond, when the prices change, the yields can change much more drastically. So if it's a shorter term bond, they're going to be less affected by yield changes than there are long-term bonds. So that's why longer-term bonds are considered even more risky, is because of how much they change in price. One risk that people are kind of unaware of with bonds is inflation risk. I mean, inflation is really either 2 or 3% based upon what source you look at. So if you're only getting 4% on a bond, you're really only getting a real return of 1%. So you got to just be aware that there's risks being too much into bonds, because you're going to have a lot of this inflation effect, reduce the real returns. Bonds are also rated by credit agencies. The three biggest ones are Moody's, Standard & Poor's, and Fitch. And they're rated kind of on this grading scale. AAA is the most strongest bonds. They have the lowest probability of defaulting. And then it goes down to the A's, B's, double B's, and then D's is like really bad, basically defunct companies. We typically invest in this portion of the bond market, the investment grade, but we will also dip our toe into what's called the high yield area, which is this double B's, potential C's. But when we do that, we buy like a huge basket of them. So there's a risk that one of these companies might default, but there's very low probability that they all will, and they usually pay higher interest. So that's basically how we shop in the credit range. So with the yield curve, typically this is how it normally looks. If you were to go and get a 1-year bond, you're only going to get like 0.13% yield, and then as you buy a longer term bond, you should be able to get more interest, right? So 2 years you're going to get double that. 5 years, you're going to get almost 1%. 7 years, you should get about 2%. And then you go way out, 30 years, you're going to get 3%. It's still not a lot of interest. Right now, when I mentioned that the yield curve is inverted, it looks more like this blue line, where it actually kind of has this very peculiar situation where the 1-year bond is paying the same interest as a 30-year bond. That makes no sense, right? It's like, why would I give you my money for 30 years when I can just give it to you for 1 year and get the same interest payment? Very strange situation, but when this signals, it's typically a sign that the economic landscapes are changing. So today, when Dave's going to talk about our bond strategy that we just created and the facets of that, I'm just going to go over basic bond strategies because there's not too many of them. There's one called a ladder, where essentially you buy bonds at different time periods so that they all come to par, basically at staggered intervals. There's something called a barbell, which is essentially what we do, where we're employing a barbell strategy, where we buy shorter term bonds in combination with longer term bonds, and they kind of counteract each other. The last strategy that's typically used is something called a bullet strategy, which is not that common, but you're trying to buy different duration bonds so that they all come to term at the same period of time. It's not very common, but we do see it by some people. So with that, I'm going to hand it off to Dave, and I will preface, when we look at research to build these different models, we first start with academic research. We want to look at stuff that has already been verified, and the first thing we look to do is to make sure that on our own data we can replicate the results.
Yeah. So Science 101 is a good experiment is one that you can replicate. There's no point in running an experiment if someone else runs the experiment and comes up with different results. So what we want to do is we compile all of this research that we think may be useful to us. We can glean some information. And we basically try to replicate it with our own data sets. The ones that we're not able to replicate, we immediately discard. And as you can imagine, there's a bunch of those. And from there, we pick and we choose through the strategies that we found that would suit our needs and kind of handle the risks that the bond markets face through the whole economic cycle. So the one strategy that we kind of really fell in love with was a strategy that looks at 3 different types of bonds. The high yield, that would be the ones that are lower on the grading scale, the C's and B's. Then we look at the high yield municipal bonds. That would be more in between your A to B range. And then, of course, your mortgage-backed bonds. Those are going to be your highest graded ones, the A's. So we consider these three markets, and we actually judge their momentum over a rolling period. And ideally, we want to be in the type of bond that's performing best. So we actually rotate in and out of the weaker performing part of the bond market into the stronger part of the bond market. And of course, we have some filters that we've tested and made some tweaks to improve the returns and hopefully lower the risk. And of course, big reasons we like this strategy was because Ned Davis, a very popular research house, has actually been tracking a variation of this strategy for the past 30 years. So that lends it a lot of credibility on top of the fact that we were able to reproduce the results ourselves. So once we kind of have the strategy, I just want to backtrack and we'll get into the model itself and the results. But I just want to go through the data preparation and the testing and building of a model so you guys can understand the process and how rigorous we are. With stocks, we talked about before that we need to adjust them for dividends and splits and things like that so we're getting accurate results. Same thing in bonds. You need to make sure that the coupon, the yield that it's showing today was accurate as well as the yield that it was showing 10 years ago and things like that. Survivorship bias, same thing in stocks. Some companies get bought out, delisted, merge with other companies, and a lot of these data providers actually remove them from their databases when that happens. But in reality, if you were investing at that time in the past, those companies would have been there for you to actually trade on. And the same thing with bonds. When they come to maturity, or companies get bought out or vice versa, their bonds disappear. And we have made sure that we have a database that is essentially the entire universe of whatever was. And then, of course, we need to make sure that everything's accurate on the dates and the volume for reasons I'll get into on this slide. Then once we've made sure we have accurate data, we begin our testing process of building and seeing how the models would have done historically. The easiest prevention we have against bad research is to use what's called in-sample and out-of-sample testing. This is where we split the historical data into two segments. We will build and research on one segment of the data. We find the model that we like, we're comfortable with the results that we found, and then we will actually test it on the other segment of the data. And if those results are consistent, that gives us a lot of confidence that as the data changes, our model is going to perform similarly as we expected from our research. Another thing, the survivorship bias data, we make sure that we use all of the bonds that were available. Look ahead bias, right? You can't pay yourself the yield before it was actually given to you, so we make sure that we're not incorporating any future earnings into our historical testing. And of course, for stocks, it's a very simple example. You can't buy $10 million of a $1 million company. And same thing with bonds. If there's only so much issued, you can only buy that limit. So we make sure that we account for that. And then the final one, we don't want a model that's too complex or nonsensical. So what I mean by that is if we found something in our research that cottage cheese prices are highly correlated with a bond going up, that's not something that we actually think is a model that we want to use, right? It's great, the data shows that it's great, but we're not going to be investing on the correlation between bonds and cottage cheese prices. And then after we've done that and we've built the model we're happy with, we actually start to validate the model. So some of the things we do to validate the models here, we actually build alternate realities or simulated futures. So we create handful, thousands and thousands of synthetic data series, different futures, which is our way of testing kind of whatever the market throws at us. We've kind of already seen it in our testing. And we can be comfortable with the results in our testing, then we're comfortable kind of with whatever the market throws at us. And I think that's where a lot of the confidence comes from and why we kind of say we're looking forward to, not looking forward to, but we would be fine in a recession. And that kind of, there's other stress testing methods. We can kind of, gloss through those. But one of the big things we do is, so in 2008, TLT, which is like a longer dated bond ETF, it had an enormous year because a lot of the money was flowing out of the stock market and real estate and into the bond market. So what we do in our models is we look for these significant one-time events and we will remove those from our research. because we don't want our model to be overly reliant on one outlier, one significant event. So we like our models that even if we remove the best of times, are we still happy with the performance of the model? And if that answer is yes, that's really good, because you will have your ups and downs. But if you're happy without the ups, then that's a good model because you'll still get some. And finally, the cluster removal. We don't want all of our performance to come from one type of graded bond, right? So if all the performance is coming from the Bs, then we actually want to remove the Bs, and are we happy if it's just the As and Cs? And if that's true, then that's great, and we'll obviously go through and do that with all the different clusters, so we can be really confident in our strategy. And one of the things that this model is really a momentum model, and I'll get back into, like I mentioned, that we check the performance and then we kind of go into the best one, the one that's been performing the best. And the reason why momentum works is because group psychology and herding really exists in a lot of our lives outside of the market. So there's no reason to think that it wouldn't work also in finance and investing. And George Soros, a very famous trader, I think he's well known for breaking the Bank of England, wrote a philosophical paper that's been published about reflexivity, and it basically talks about that higher prices get people to chase it, and then the chasing actually causes higher prices, which causes people to chase it. So this momentum is actually rooted in philosophy and science and psychology.
So this was the Ned Davis model. This was the data that we received and we were really interested in because it looks pretty darn good to just have a starting point. What we also did is this red line here is just those 3 funds that we use, just equal weight. So we just own an equal weight of each one. And the cool thing is if you just own those, you actually have a pretty darn good return just by doing nothing, no strategy. So that's a nice place to start because you can just be lucky. We can literally just randomly be in this strategy, and chances are we're going to at least achieve the returns of the red line. So that really, really helps. So then now what we were interested in replicating was the blue line, where it's essentially using the investments from red and just holding one of them at the time. And so that's what we aim to replicate in our own data. So if you go to the next slide, this was from our own backtest database, and we were basically able to do basically the same returns using different instruments. And so the beauty of this is it's a kind of a very steady strategy. It doesn't have tremendously huge up or down years, but it on a 1 month period over basically was it 25 years, it pulls in basically almost 0.75% return on a 1 month basis. So in the bond market, that's actually very significant. Bonds typically don't return all that much. And the other thing we will mention is we found in the previous slide, there's never been a 3-year period. Is it in this one? Or
Yeah.
It's here.
So in the worst 3-year period in our entire research of this model returned at least 10%.
Right.
So that was really, really good. And I think the key takeaway for us was that even though the strategy, the model itself is momentum based, it actually has some roots in value.
Right.
And people are finding investing in bonds at a time where they think that bonds are presenting value to them,
A discount.
like '08.
Yeah.
And I think, like John mentioned, the 2 loaves of bread, when it's buy one, get one free, value takes time to play out, right? You don't buy 2 loaves of bread and come home and immediately eat them. But after 2 weeks, that value starts to show itself where you have that bread at the discounted price. And it's the same thing with this, it takes time, and after time, you could really, really see the outperformance of this bond model compared to just a simple buy and hold.
Yeah. So that you'll see this model start to work its way into everybody's account. We're going to start by putting only half of the fixed income that we have allocated towards this and just get it kind of going and everybody rebalanced. And then once this kind of starts to pick up some good gains, we'll probably slowly move it into basically the whole allocation. So this also be really great for clients who might not be in the most risky models. Like we do have very, very low risk, like only bond models that we don't talk about all that much because there's very few people in them. But you can see we're basically going to try to shoot for similar to stock market returns. I mean, it's not going to be as much with just using bonds. So that's going to be kind of the goal. And we're really excited to be able to try to enhance that other part of the portfolio that everybody has. So any more questions on this? It seems, to us it's sometimes straightforward, but we always really like to answer anything that might have gone over anybody's head, kind of clarify anything so that it makes sense. No questions? Okay, well with that, that's the end of our presentation. I want to thank you guys for coming. We're going to continue kind of with the Back to Basics series. We're going to kind of keep going with some more elementary topics and try to build a strong foundation of finance and investments and really not get too complex over the next few presentations. So really appreciate your feedback on those forums and stuff, and make sure to have some food on the way out. Appreciate it.